You know that sinking feeling when your accountant says you made $40,000 last month, but your bank account's emptier than a church on Super Bowl Sunday? Yeah, I see that look. You're not crazy. Your OpEx classification is lying to you. Today we're talking about operating expenses, OpEx, the true overhead bucket in Profit First for commercial construction. Not the fantasy number on your P&L. Not the guess your bookkeeper made when they dumped everything that wasn't a material invoice into operating expenses. The real number, the one that actually matches what walks out of your bank account every month. Because here's the truth. Most construction companies don't know what their overhead really costs. And that ignorance is very expensive. If you've been running your business off a standard P&L, you've been building on wet concrete. It might look solid, but give it time and pressure and the whole thing cracks. Standard business advice treats OpEx like a catch-all bucket. Whatever shows up in operating expenses on your profit and loss statement becomes your overhead number. For a retail shop or a consulting firm, sure, that might work. But construction, that's like using a tape measure that's missing the first 6 inches. The number looks fine until you actually try to build something with it.
PFCC, Profit First for Commercial Construction, fixes two massive problems that standard Profit First completely misses. First, it separates every penny of direct job cost out of overhead and moves it to a dedicated JobEx account. Because when you run subcontractor invoices or material costs through your general OpEx bucket, you're hiding margin problems. That job looks profitable on paper, while your overhead account bleeds cash for costs that should have been charged to the project. Second, it includes cash outflows that your P&L pretends don't exist, like principal payments on equipment loans. Your profit statement might say you spent $50,000 on overhead, but if you wrote checks for $58,000 because of equipment notes, you've got an $8,000 gap between fantasy and reality. Your P&L is like a restaurant menu. It tells you what's available. Your bank account is like your wallet. It tells you what you can actually afford. PFCC makes sure your OpEx number matches your wallet, not the menu.
Let me show you how to build your real overhead number. Grab a napkin. This is simple.
Start with your P&L operating expenses. That's your baseline, the number your accountant shows you every month. Subtract non-cash items like depreciation and amortization. These are accounting entries that make your CPA happy, but don't move a single dollar out of your bank account. Subtract owner draws and taxes. Why? Because these get funded from your profit, owner's pay, and tax allocations, not from overhead. Mixing them up is like putting your grocery money in your rent envelope. Works great until the landlord shows up. Add cash principal payments on all your business notes and leases. This is the money that actually walks out your door every month, but your P&L hides like a teenager avoiding chores. OpEx equals P&L expenses minus non-cash minus owner and tax plus principal payments. Let me show you with real numbers. Let's say your P&L says you spent $75,000 on operating expenses last month. Start $75,000 P&L operating expenses. Subtract $4,500 depreciation, no cash moved. Subtract $12,000 owner draws, funds from profit, owner tax, not OpEx. Add $2,800 equipment loan principal. Add $1,200 truck lease principal. Real cash adjusted OpEx, $62,500. That's a $12,500 difference between what accounting thinks you spent and what your bank account knows you spent. Multiply that by 12 months, and you've uncovered $150,000 in hidden overhead behavior. You can't manage what you don't measure correctly. And if your OpEx measurement is wrong, everything downstream is wrong too.
Here's where contractors get confused and expensive. You need 2 simple tests to classify any expense in 10 seconds or less.
Test 1. The job specificity test. If the expense is required for a particular project, it's JobEx. If it supports the business broadly, keeps the lights on whether you're running 1 job or 10, it's OpEx. Let's run through examples. OpEx, business overhead that keeps you capable. Long-term equipment notes and leases, even if that skid steer works on jobs all day. Field supervision that floats across multiple projects. Baseline health insurance and general liability. Shop fabrication for general stock, not a name project. Annual certifications, contractor licenses, office rent, utilities, administrative salaries. JobEx, direct job costs tied to specific projects. Subcontractors and materials, always, no exceptions. Direct job labor, your W-2 field crews working project by project. Short-term equipment rentals, that 3-day crane rental for the concrete pour, permits, bonds, and compliance required by the project, job-specific testing and inspections, employer payroll burden tied to job hours, shop fabrication for a named project. You're going to hit a lot of situations where you've been running sub-invoices through your overhead account. No wonder your margins look like Swiss cheese. And when you do that, you can't see which jobs actually made money and which ones just look pretty on paper. The whole point of separating JobEx from OpEx is to expose margin behavior, and you do that with separate bank accounts. JobEx goes into one account, OpEx into another. When job cash and overhead cash live in separate places, you can't accidentally pay overhead expenses with job money. Your gross margin becomes visible instead of theoretical.
You're going to hit gray areas. That's construction. Nothing ever as clean as blueprint suggests. So here's your decision framework.
For equipment, short-term, job-tied rental goes to JobEx. Long-term notes and leases go to OpEx or CapEx. A 3-day crane rental versus a 3-year skid steer lease. The difference should be obvious. For labor and burden, supervision across multiple jobs stays in OpEx. Supervision dedicated to one job gets allocated proportionally to JobEx. Employer payroll burden tied to specific job hours follows the job. Baseline benefits stay in overhead. For fabrication, building assemblies for a named project goes to JobEx. Fabricating general stock or unassigned items stays in OpEx. For compliance, project-required inspections go to JobEx. Annual company certifications stay in OpEx. If you wouldn't buy it without that particular job, it ain't overhead.
Here's why this classification matters so much. Your ability to take profit depends entirely on controlling your cash commitment base. Revenue minus JobEx minus OpEx equals residual revenue. Let's do the math quick.
Say you bring in $100,000 in revenue this month. JobEx, all direct job costs, $65,000 OpEx. True overhead, including principal payments, $23,000. Revenue minus JobEx minus OpEx equals residual revenue. That's $12,000 left over. That 12% is your residual revenue, the only cash available for profit distributions, owner's pay, and tax allocations. Everything else is already spoken for. If your JobEx and OpEx together eat up 88% of your revenue, you've only got 12% to live on, pay taxes, and take profit. That's not a business. That's a job with extra paperwork. PFCC gives you the visibility to see this in real time. You're not guessing. You're not hoping. You're looking at separate bank accounts that show you exactly where you stand.
One more thing before we wrap. Equipment purchases can destroy your cash flow.
PFCC's solution: pre-fund a CapEx account from your OpEx allocations. Here's the quick math. Let's say you need to replace a skid steer every 5 years at $60,000. Instead of crushing one job or 1 month with that purchase, you allocate $1,000 a month from OpEx into a dedicated CapEx account. $60,000 divided by 60 months equals $1,000 per month. When it's time to replace the equipment, you've got the cash sitting there. No scrambling, no surprise loan, no margin destruction. This keeps your overhead stable and prevents equipment cycles from wrecking your profitability.
Look, here's the bottom line. OpEx is your true cash-based overhead bucket. Keep job costs out. Include the cash outflows your P&L ignores, especially principal payments. Use the job specificity test to classify expenses in 10 seconds or less. And pair OpEx with a dedicated JobEx account in a separate bank so you can actually see where your money goes. Do this right, and you'll finally stop wondering why profitable months still leave you broke. Do it wrong, and you'll keep chasing cash while your P&L lies to you with a straight face. If you want the full system, the accounts, the allocations, the decision rules, all of it, grab the book Profit First for Commercial Construction on Amazon. It's the blueprint for construction cash flow that actually works. And if you're tired of fighting this battle alone, head over to profitfirstconstruction.com and schedule a call with our team. We specialize in helping contractors like you stop guessing and start knowing where every dollar goes. Hit subscribe if this is helpful. Share it with another contractor who needs to hear it. And we'll see you on the next one.